at Fitch Ratings. Ed, good to see you. Tell me a little bit about this latest report. You're saying that that there are imbalances that'll test European high yield?
Well, I don't know if I could have said it better than your guest just did. You cited a luxury car retailer in the UK, and you cited an oil and gas company cutting capital expenditure on the continent. So what that highlights is that we're getting more consumption in the UK, and people are borrowing money, and they're buying things that may not be productive. And one of the sectors where money was actually being spent on real investment was the oil and gas sector, and that's been declining dramatically. So as everyone gets excited about a lower euro, lower energy prices, and the ECB, the export story in continental Europe is certainly likely to carry on. But with that come very large surpluses that we saw in 2007. So in 2007, those surpluses were absorbed by the periphery, where there was a consumption boom and lots of fixed asset investment in unproductive sectors. So as we get large surpluses, those are external imbalances that have to be met by domestic imbalances or deficits in the importing countries, such as the UK and the US. So I think your previous guests highlighted that. And then I would just finish by saying that the external imbalances produce internal imbalances insofar as the more of the export sectors do well, then the importing sector, the export sectors in the UK and the US will do poorly. And so any growth that we get is likely to come from more credit-fueled growth in fixed asset and potentially unproductive consumption.
Yeah, I think that all sort of sounds quite rational, but comparing it to the pre-crisis, pre-financial crisis sort of era, is that stepping a little bit too far, given that the confidence levels that we currently generally have are completely opposite to what we had back before the financial crisis?
No, I think the confidence was sky high in 2007. And if you look at and I'm talking about early 2007, it really wasn't until the summer that the impact of those subprime defaults really started triggering concern about a lot of very fragile balance sheets in what we call the shadow financial system. But in 2007, we saw corporates borrowing to do large share buybacks and to pay dividends. We saw more marginal borrowers, not just in housing, but also in leverage credit, doing covenant-light loans and payment-in-kind bonds. And we would see issuers that would issue, in late 2006, come back in early 2007 and refinance at higher leverage, but with more aggressive financing structures. And that's the kind of activity that we see now. The other parallel is that 2007 was 5 years since the last default cycle. And here we are in 2015, and the last default cycle ended towards the end of 2009. So that's very similar. And then the other similarity is just that the imbalances. Back in 2007, it was China and the US, and then these internal intrazone imbalances. Yeah. But today, the imbalances are between Europe and then the US and the UK.
Ed, thank you very much for your time. Ed Ironman, Managing Director at Fitch Ratings. Keep your emails coming. European Closing Bell at CNBC.com. Get in touch on Twitter at Louisa Boysen. It's always nice hearing from you. Now, straight out to Bertha Coombs for the Global Markets Report here on this Tuesday. Bertha, hi, how are you?
I am doing well, Louisa. We are watching a market that is pretty much the color of my top all around. All 30 Dow components are trading to the downside. What we're watching is a broad sell-off led by the likes of the industrials and a lot of those companies that are multinationals, as we're watching the dollar index today at multi-year highs, fast approaching that 100 level, something we haven't seen since the start of the century. Overall, as I mentioned, we're seeing a broad sell-off. The one safe haven today, for the most part, has been the utilities. They have been under pressure of late as the markets have moved higher. Today, a bit of a reversal, and they are actually leading the way higher. We're also seeing tech overall selling off. Apple today, one day after its big presentation on the Apple Watch and introducing some new research platforms for Apple apps. Today, the stock is sort of battling the $124 level, down at about a 1-month low. We're watching the S&P right now below its 50-day moving average. Apple is still above there, and so are the large caps on the NASDAQ, but it is having a wait. It is meeting with investors, so we'll see if we learn anything more